On July 24, 2026, something happened inside COMEX vaults that most silver investors missed entirely. Everyone was watching the spot price bounce between $58 and $61 an ounce. Meanwhile, a much quieter number was moving in the background, and it tells a different story than the one making the rounds on social media. For months, retail investors had been told that COMEX registered silver, the metal actually available for delivery, was collapsing toward crisis levels. Some claimed it had fallen to around 42 million ounces. The real figure, taken straight from CME Group's own warehouse data, was closer to 82 million ounces, and by late July it had climbed above 96 million. That's not a rounding error. That's nearly double what people were repeating as fact. Once you understand why that gap exists, you'll read every future silver squeeze headline a little differently. First, the part almost nobody bothers to explain: the difference between silver that sits in a vault and silver that's actually promised for delivery. Every ounce stored in a COMEX approved depository falls into one of two buckets. Eligible silver meets the exchange's purity and bar standards and sits in storage, but it isn't earmarked for delivery against a futures contract. Registered silver has gone through a formal process where the owner has pledged that specific metal as deliverable supply. It's the difference between money sitting in your savings account and money you've already written into a check that hasn't been cashed. Both are real, but only one is committed to a transaction right now. As of late July 2026, held about 339 million troy ounces of silver total. Roughly 96.2 million of that was registered, and the remaining 234.7 million ounces sat in the eligible category. That eligible pile is enormous, and it can convert into registered status fast if bullion banks decide to commit it. This is the distinction that gets lost every time someone quotes only the registered figure and treats it as if that's the entire available supply, when hundreds of millions of ounces are really just one paperwork step away. The registered number alone doesn't finish the story either. You also need to know how many futures contracts are actually standing for physical delivery instead of settling in cash or rolling forward. This July, that figure stood out. Fresh CME data showed July delivery intentions surpassing 37 million ounces, more than 7,000 contracts, over 1,000 metric tons of physical silver changing hands. On one day within that reporting window, more than 163 new contracts got added, close to 5.8 million ounces in a single session. That's not retail behavior. The names taking delivery included some of the largest financial institutions in the world. JPMorgan Securities stood for hundreds of contracts, and Macquarie Futures, BNP Paribas, RBC Capital Markets, and Deutsche Bank all showed up accepting physical metal instead of just trading paper exposure. When institutions that size choose delivery over cash settlement, it says something about how they read the metal's trajectory. Though it's worth being precise here, delivery notices don't always mean silver physically leaves the vault right away. A depository receipt can change hands 2 or 3 times within a single delivery month as institutions inspect available inventory before redelivering the same metal the next day. Keep that in mind, because it's exactly the kind of detail that gets lost the moment a chart gets clipped down to 10 seconds for a social post. To see how unusual the past year has actually been, go back to October 2025. Registered silver inventory sat comfortably above 120 million ounces. By February 2026, that number had dropped below 100 million for the first time in years. The exchange reported a single-day negative adjustment of more than 3.2 million ounces in the registered category alone, plus nearly 4.7 million ounces leaving the eligible category in that same 24-hour window. Movement that size doesn't happen for no reason, and analysts at the time pointed to physical demand accelerating right as Shanghai prices held a persistent premium over COMEX. By the end of February, registered stocks had dropped to around 86 million ounces, a 31% decline from just months earlier. Then March arrived, historically one of the heaviest delivery months of the year, and the market got its real stress test. On first notice day for the March contract, delivery notices went out on over 10,000 contracts, more than 52 million ounces, over 60% of the entire registered inventory absorbed in a single delivery cycle. Add a price surge that had already carried silver to an all-time high of 121.62 an ounce in January, and it starts to make sense why CME Group raised margin requirements from 15% to 18% in mid-February, specifically to cool speculative positioning before March hit. Raising margin requirements does something specific to a market like this. When an exchange increases the collateral traders need to hold a futures position, leveraged players either post more capital or close out. A lot of them closed out. That set off what traders call a leverage unwind, and it sent prices tumbling from January's peak back toward the $80 range within weeks. Here's the part that should actually surprise you. Even after that violent correction, even after billions in leveraged paper positions got forced to liquidate, the physical scarcity underneath didn't go anywhere. Registered inventories kept falling through March. By late March, some tracking services put registered stocks as low as 76 million ounces against roughly 576 million ounces of total silver futures open interest, a coverage ratio of just 13.4%. Anything under 15% is flagged by exchange analysts as stress territory. The paper unwind cooled the price. It barely touched the tightness underneath it. That gap between paper positioning and physical reality might be the most important thing happening in silver right now, and it's the part most coverage skips past entirely. If you're wondering whether this is a COMEX only story, as of early April 2026, SHAFE silver futures traded around 84.59 an ounce, while COMEX contracts for the same delivery window sat closer to 74.94, a spread of roughly $9 to $10, or 12 to 13%. Under normal conditions, traders buy the cheaper contract and sell the more expensive one until prices converge. That gap wasn't closing. When arbitrage stalls like that, it usually points to a real barrier moving physical metal between regions, whether that's export restrictions, logistics, or genuine regional scarcity. A premium this size, holding since late 2025, tells you Asian buyers are willing to pay meaningfully more for physical silver rather than wait for the gap to close on its own. You don't see that in a market with freely flowing supply. So what about the registered inventory panic narrative that kicked off this whole conversation? CPM Group's Jeffrey Christian, who's covered this market for decades, has pushed back on the more sensational version directly. He points out that a depository receipt can legitimately change hands 2 or 3 times within a single delivery month with zero real drawdown in registered stocks because some participants stand for delivery just to inspect available inventory, then redeliver the same metal the next day rather than tie up capital posting its full value for weeks. That's routine. It's not evidence of a crisis. On the investment side, silver ETF holdings fell roughly 13.4 million ounces between mid-May and mid-June 2026, which looks a lot more like investors taking profit after a historic run than any structural collapse in demand. Some of what reads as alarming here is really just ordinary market mechanics dressed up with urgent language, because urgent language performs better online. But don't swing too far the other way and assume everything's fine. Even the more measured analyses agree on one thing: the coverage ratio, registered silver relative to total open interest, has compressed to levels that are genuinely rare historically. Sitting somewhere between 13 and 18% depending on the week, that's not a comfortable buffer. It leaves almost no room for a surprise wave of delivery demand without real friction. Paper leverage across silver futures has also been running elevated, roughly 5.5 times the deliverable metal available, meaning there are a lot more paper claims circulating than registered silver to satisfy them if a meaningful chunk of holders decided to stand for delivery at once. That's not automatically a crisis. Since most futures contracts were never meant to end in physical delivery, most traders close or roll positions long before delivery month even arrives. But it does mean the system has very little slack. Thin slack plus real industrial demand growth is exactly the kind of setup that's preceded sharp price moves before in either direction. Industrial demand matters here too, because silver isn't only a store of value people buy and lock away, it's used in electronics, solar panels, EV components, medical devices. That dual identity means silver futures answer to 2 different forces at once: macro sentiment around inflation and rates, and actual manufacturing demand on the ground. Through 2025 and into 2026, both of those forces have largely pointed the same direction, and the market has been squeezed from both sides at once: investors chasing an inflation hedge, manufacturers competing for the same bars to keep production lines running. That's a different setup than the retail-driven silver squeeze of 2021, when a wave of individual buyers loosely organized under the Drain COMEX banner pushed people to take physical delivery, partly as a statement against how the paper market was structured. That grassroots push did line up with a faster inventory decline at the time, but what's driving today's drawdown runs deeper: central bank policy uncertainty, a genuinely tightening industrial supply chain, and now large institutions standing for delivery rather than settling in cash. None of this is happening in a vacuum either. In the most recent sessions of late July 2026, silver has been swinging with Middle East headlines, briefly dropping more than 3% in one session before rebounding on news of a pause in hostilities between the US and Iran. That pause pushed oil prices down, which eased inflation expectations and cooled talk of the Fed needing to tighten aggressively at its upcoming meeting. Markets were pricing in roughly a 30% chance of a hike this meeting, closer to 80% for one in September. Why does that matter for silver? Precious metals compete directly with interest-bearing assets for investor money. When rate hike odds rise, holding non-yielding metal gets relatively less attractive next to bonds or cash, and that can pressure prices even while physical supply is tightening. That tension, scarcity pulling one way, rate expectations pulling the other, explains a lot of the volatility we've seen. Silver swinging from January's all-time high near 121 down into the 70s, now sitting somewhere in the high 50s to low 60s. Who benefits from all this and who's exposed? Bullion banks and large institutions with the balance sheets to take physical delivery stand to gain, assuming they can source metal at decent prices before the buffer thins further. Mining companies benefit from a higher average price environment too, provided their costs stay in check, since a wider gap between production cost and spot price improves margins. Retail investors holding physical metal watch the value of what they already own climb with the trend, though they're also the ones most exposed if they bought near January's peak and panicked during the leverage unwind that followed. Manufacturers who depend on silver as an input, especially in solar and electronics, face real cost pressure if scarcity holds, and some of that cost eventually lands on buyers further down the chain. And heavily leveraged speculative traders are the ones most exposed to exactly what happened in February: a margin hike, a forced unwind, and a reminder that leverage cuts both ways without much mercy. It's worth being honest about what we don't know here too. Nobody, including the exchange itself, can say for certain whether registered inventories keep climbing. They did tick up 10.1% over the most recent 30-day stretch, or whether that's just a temporary reclassification of eligible metal ahead of the next delivery cycle. Whether Shanghai's premium reflects a lasting shift in global silver flows or a temporary imbalance that eventually closes remains an open question. Markets that look tight can loosen fast if bullion banks convert a large block of eligible silver into registered status. Markets that look calm can tighten just as fast if institutional buyers decide all at once to stand for delivery the way they did in March. Anyone claiming total certainty about what happens next in this market is selling you something that doesn't exist. What we can say is that the mechanics here matter more than the headlines. A coverage ratio compressed into the mid-teens isn't the kind of thing that shows up in a 30-second clip, but it's exactly what determines whether the next delivery month passes quietly or turns into another sharp price move. The gap between that alarmist 42 million ounce figure circulating online and what CM Group's own data shows closer to 80 to 96 million depending on the date says a lot about how fast bad numbers spread in a market this emotionally charged, and how quickly anyone can check the real figures for themselves if they know where to look. And the fact that JPMorgan, Macquarie, BNP Paribas, RBC, and Deutsche Bank are actively standing for delivery, not just trading paper around it, tells you sophisticated capital is treating physical access as worth pursuing right now, even with all this volatility in the mix. Heading into the back half of 2026, the registered inventory figure stays the number to watch because it sits right at the intersection of everything covered here: industrial demand, investment flows, institutional delivery behavior, and the gap between paper claims and physical metal. If the coverage ratio keeps compressing while institutional delivery demand stays high, expect more volatility every time a new delivery month gets close. If bullion banks respond by converting more eligible silver into registered status, that buffer could rebuild and ease some of the pressure. Either way, this goes beyond silver. In any market running on both physical scarcity and financial leverage, the real story usually isn't the price on your screen. It's the inventory classifications, the delivery notices, the coverage ratios that almost nobody checks until something breaks. So here's a question worth sitting with. If institutions with every resource to verify these numbers themselves are still choosing to stand for physical delivery instead of cash, what does that tell you about how they're positioned for what's next? And are you watching the same signals they are? Leave your take in the comments. I want to see where people land on this one. If this helped you cut through the noise on what's actually happening inside COMEX, a like helps more people find it. Subscribe if you want more of these breakdowns. And if you're curious how silver got to an all-time high in the first place, the video right after this one covers exactly that.